Everyone, this is Vishal from Uncharted FX, and today was the big day. Today was the Federal Reserve interest rate decision, and the Federal Reserve has cut interest rates down to 2.25%, so cutting by 25 basis points as expected, as the market was expecting and had priced in. And I talked about this in my previous video where we went through the four scenarios that would have came out of Fed Powell's mouth today, and he chose the cutting by 25 basis points, and he didn't really act dovish. So let's just look here at CNBC. Jerome Powell, and I did watch the conference, he did say that this move was a mid-cycle adjustment, hinting more cuts are not a guarantee. However, I just want to clarify that he didn't say that they're stopping, they're not going to cut anymore, and he didn't say, that we are one and done. So very vague. He is leaving the door open. And again, if you do follow my work, I believe that the Fed wants to cut rates many more times. And really what this is now a way to maintain confidence in the system and to also save face. The Fed has to pretend that what they're doing is working, and that's what we are in now. This is the cycle we are in. We are heading to some sort of economic crisis / reset. Again, it could go either way. It could go to a hard money system, or it could go to a digital currency where everything is taxed and tracked, and that's what we're going to need anyways for, let's say, MMT. So I gave 5 reasons on why the Fed is going to cut rates. The bond market, the yield. So let's look at the treasuries. So we'll look at the charts quickly first. Let's look at some of the bond market charts. So again, a big surge in bonds. And essentially we had yield drop, except on the 2-year. While it failed to break above this important resistance zone, you can see here a bit of a head and shoulder, and even a head and shoulder within a head and shoulder here. But if you look at the treasuries here, okay, so the 1 month is down, 3 month, look at the 3 month, 2.06. And wow, look at the 10-year at 2.00. So you have the 3 month and the 6 month yielding much more than the 10-year here. So still work to do if they are trying to create a normal yield curve. And the market, I believe, is pricing in more cuts. So let's look at the other reasons here. So the real economy is actually not improving. I think this is, you can see even today, if you're watching financial media and stuff, a lot of people are now even admitting that there is a slowdown in production, whether it's an actual cyclical recession, or if it's due to, say, trade wars and stuff. That can be debatable. Third, so again, we talk about cheap money, and I've mentioned this a lot in my work and on my channel, that these markets, and we'll talk about this, these markets are only going up because they hope that there is a Powell put where there's nowhere else to go for yield as interest rates are dropping. You're not really going to go into real estate until you've seen the bottoming of the rate cuts. Are you going to put your money in bonds for yield? Probably not. What's left, it's really only stocks. That's the only place to go. And the market just wants this reassurance that, this Fed mandate, the new Fed mandate that I argue is to keep rates and keep stocks and assets propped. And that's what the market wants. They want more cheap money because then there's nowhere else to go except stocks. So again, the debt, we talked about this, a lot of consumers are hurting. They're going more into debt, and they need people to have more access to debt, meaning more cheaper money. We'll look at 4 last because this is what I really want to talk about. But the 5th one, again, he has talked himself into a corner. You can say he sort of got out of it, but it's it's strange, a one and done rate cut. He was very vague on saying whether they're going to cut, or he even didn't mention, the next crisis will have options because you're assuming we're not going to be raising interest rates. So very vague. And before we get to the fourth thing, let's look at what President Trump had to say here. What the market wanted to hear from Jay Powell and the Federal Reserve was that this was the beginning of a lengthy and aggressive rate cutting cycle, which would keep pace with China, the European Union, and other countries around the world. As usual, Powell let us down, but at least he is ending quantitative tightening, which shouldn't have started in the first place. No inflation, we are winning anyway, but I am certainly not getting much help from the Federal Reserve. So this opens the door to, is Jerome Powell's job, safe at the Federal Reserve? President Trump wanted more cuts, and we'll see what happens, how this develops. Does that mean Powell will have to cut rates more? We'll find out. One interesting thing I want to mention too is I was watching CNBC and they had guests who were saying that he should have actually cut by 50 today, 50 basis points, because that's really what the market wants. And not only that, but if you're gonna start cutting with 25, you might as well don't leave the market in suspense for the month after. Just cut the 50, because we all know that that is what is going to happen. So this is interesting what President Trump said. All central banks right now are talking about cutting. There really isn't any central bank that's talking about hiking rates. So the more interesting thing now I want to go to is this one. The Fed has to relieve pressure, mostly from emerging markets. Emerging market dollar-denominated debt gets more expensive as the dollar gets stronger, which leads to more problems, and also plays a factor for those nations to buy oil from Iran, bypassing the US dollar. So essentially, when central banks cut rates, they do so as an aggressive way to try to talk down their currency, right? So if you look at, say, the euro, the European Central Bank has promised more rate cuts, deeper into the negative, and more stimulus as well. And now the Fed is, technically sort of joining the party, and I think this is going to be stressing them out a lot because the dollar is still going higher. And the theory of this, again, I did an article on the 3 reasons of why the US dollar will go higher. It goes to the dollar being the reserve currency, so it's sort of like a safe haven. Second, it's due to Treasury yield. So if you're a German fixed income trader, US Treasuries still yield about 2%, which is, and you'll see here, let's look at what German yields and Bund, yield. Look at this, still negative. Just the 30-year yields positive. So if you're a fixed income trader in Germany, you're probably going to be buying treasuries, right? And this means a more run into the US dollar. And the final aspect is that all these central banks are going to be cutting rates and, including stimulus. So if everyone is doing this, where would you rather be in? You'd probably want to be in the dollar, just because, again, it is that reserve currency. It is the hegemon, the strong power, the military, etc., etc. So this surprised a lot of people, because technically when a rate cut happens, it should be going down. And I believe this has to be because, Jay Powell did not talk the dollar down. The market right now is pricing that the European Central Bank will be actually more aggressive, will be cutting rates much more, and will also be, providing more stimulus than the Fed. So, you might as well run into the dollar. So now these central banks are competing with each other to see who can be more dovish than the other. And this is where, Fed Powell sort of did drop the ball. And, that's what President Trump thinks, because he should have been more dovish. And he didn't talk the US dollar down. So one interesting thing that you should note is Jerome Powell also mentioned how the quantitative tightening policy, so this is the Fed selling off their balance sheet rather than quantitative easing, where they're increasing their balance sheet, which in the 4 rounds of quantitative easing, it went from $800 billion to about $4.2 trillion. So he announced that they're going to be cutting quantitative tightening much sooner than expected. So the original date was set at the end of September, so they would stop their QT program at the end of September, but now it's being moved 1 month earlier, where quantitative tightening will end at the end of August. And now, you know, you're going to hear a lot of people talking about, is the Fed sort of setting up now for future QE and future rate cuts? And again, this is what I am watching. I have already talked about the dollar going higher in all my works, through my social media, through my blog posts, and through some of my videos. And as the dollar gets stronger, that's when all these problems of the world are going to exacerbate. So we are in that cycle now where we're expecting more rate cuts, and now it's about central banks maintaining confidence in the system. This is what they're trying to do. This could be a geopolitical event where something happens geopolitically and the Fed comes out saying, oh, you know, look, now we actually have to cut rates back down to zero because of this. So it is all about maintaining confidence. If the Fed just came out saying, hey, look, you know, we screwed up with our policies, we have to go to zero, blah, 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 you know, confidence will be lost. People will run into gold and Bitcoin, etc. And I think the smart money already is, because they realize that the confidence crisis is going to come. So gold is generally a confidence crisis hedge. When people lose trust in the government, lose trust in central banks and the fiat money, they run into gold and perhaps even Bitcoin. So I'll quickly look at Bitcoin here. I'm watching this on the 4-hour, perhaps a nice head and shoulders pattern here at a very strong support level, or flip zone that I call, that you can learn about through my course here. So this is very interesting, and interestingly enough, gold did fall because, of course, what happened with the US dollar. So it'll be interesting to see what happens here. I personally don't trade these big events because of the volatility. I mean, this could very easily be a fake out, but again, all these other central banks are cutting and, you know, stimulating much more than the Fed. So where would you rather want to be in? And I think you have to be in the dollar. Even when the Fed goes more dovish, America is still better off than, say, Europe and stuff. So this is the problem, right? The Fed has, where they'll have to eventually kill the US dollar. And, you know, that's what we're going to be probably seeing in the future. As the dollar gets stronger, that's when the issues get more exacerbated. So let us look at the S&P, and yes, there was a big fall here. You can see here now from higher lows we made our first lower high. And why did this happen? Again, that 25 basis points was already priced into the markets, and the market wanted to hear more about cuts, more cuts coming, and Powell did not deliver. However, again, even with this rate cut, there's nowhere else to go for yield. And even when rates go even lower, where are you going to go for yield, right? Are you going to, like I said, buy real estate? You know, if it's a one and done, sure. But I think generally people understand that rate cuts happen sort of in cycles. And, you know, you're not really going to go into bond because you're not going to be sitting there for like subpar yields. So the stock market's going to be the only place to go. And basically the market wanted to hear the Fed essentially say, look, we got your back. We're ensuring that these markets will not go down. And trust me, folks, that is still their mandate. It is to keep assets propped. But you got to realize this is all a confidence game now. They can't just come out saying all this stuff. A lot of the smart money, like I say, already know that they're probably cutting rates much more, and they will be going back to quantitative easing. And when that happens, remember, QE was supposed to be a one-time thing only, you know, to save us from another repeat of the 1920s-30s depression. And now people are going to realize that it is the norm. Best case scenario is what we see in Japan and in Europe, with sort of stagflation for decades, but that means the dollar may lose its reserve status, because, you know, if the Fed starts to keep rates suppressed by buying all this excess bonds, you're not really going to be putting money into the Treasury, but I mean that's in US Treasuries. But again, let's see what the dollar does. I'm still a dollar bull. I believe as the dollar goes higher, which I've listed again many times in my blog posts and videos, that's when the real problems will happen. So again, now let's see how other central banks will react. If the Fed will remain dovish, see how President Trump will react to Powell. Will he fire him? Will he pressure him to cut rates much more? Just again, interesting times that we are living in. So again, thanks for taking the time to watch my video. If you like what I said and found it interesting, please give the video a like. And if you're not following me, please also give me a follow. All right, thank you.